What is short selling? Short selling is a means to profit when an asset decreases in value. This asset could be in the form of stocks and shares, commodities, funds or currencies. Short selling, or shorting, is often associated with large, institutional investors such as hedge funds and investment banks. This reached its height following the financial crisis in 2008 when hedge funds were accused of causing, or at least contributing to, the collapse of the global banking system by short-selling the shares, which led to a temporary ban on short-selling of financial institutions in many countries. Before we discuss the implications and arguments for and against short-selling, we will explain the theory behind it. For this explanation we will use two people, person A and person B, although these could be banks, hedge funds, or there could be more than two parties involved. Person A has shares in ABC, and person B believes that they may fall in value. Person B borrows the shares from person A and pays him a fee in return for allowing him to have the shares for a certain amount of time. B then sells the shares, say 100 shares at $1 each, so he receives $100. He then waits until the share price falls and buys them back at $0.50 each, paying $50 for the 100 shares, which he gives back to it and pockets a $50 difference. The profit will be less than $50 after borrowing costs and tax, but that is the theory behind short selling. If A is a long-term holder of the shares and believes that over the long term the value will increase, then they may not sell the shares at each fluctuation and so have nothing to lose by lending them out and receive a fee in return, whilst keeping the same number of shares. Often banks and institutions will lend out shares that ordinary investors in fact own, but without the investors knowing. Therefore the bank earns a fee on lending the shares out, even though they do not own the shares. Some argue that short selling is immoral or hazardous for financial markets as it encourages the market to decrease, which may cost jobs and force companies to go bankrupt. This can be true to an extent, but there are already laws that govern using them improperly, although they have not been well regulated in the past. If a company is a good company, then shorting will not force it to go bankrupt. Short selling can help investors make money from a company they think is overvalued or will have difficulties in the future, as well as allowing them to hedge current positions and therefore reduce risk.